Ausbil is a boutique investment manager celebrating its 20th year anniversary in 2017. We manage about $10 billion in the Aussie equity market, and certainly Aussie equities is the core focus of Ausbil. My background is I've been at Ausbil for 2 years now, and prior to that I've spent 23 years in the equity markets in organisations such as AMP, ING and Elliston. The Ausbil's investment team is very aligned in the fund. We are equity owners in Ausbil. We're aligned to the outperformance of the fund as we share in the outperformance, and we also have the ability to invest in our own funds as well. So we do have skin in the game. In essence, the long-short strategy tries to generate outperformance by shorting companies that go down and buying companies that go up. The heart of our long-short strategy, the 130-30 Focus Fund, is the philosophy. The philosophy is basically earnings and earnings revisions drive share prices. So we try and get the earnings right and early ahead of the curve. So we want to be invested in companies with strong earnings paths, and those companies will go up. On the opposite side, we want to be short companies that we think have structurally flawed balance sheets where the earnings will be going down, or certainly a profit warning may occur over the next 12 months. The investment objective of the fund is twofold: to generate outperformance through the whole economic cycle, but also to give the fund some capital preservation where the shorts act as a buffer to the whole portfolio when the market goes down. The style of the fund is agnostic, so we are very unconstrained. So we do rotate between value and growth stocks wherever our process leads us to generate our core objective of generating outperformance and preserving capital in the fund. To understand stock selection in the portfolio, you need to understand the process. We have a macro top-down and bottom-up process. We have a chief economist who frameworks our macro top-down picture, and we have 6 analysts covering over 200 companies doing the due diligence modelling and trying to understand the earnings paths of these companies. And we look at both macro top-down and bottom-up. Then it's up to the portfolio manager to put these stocks in combination, not in isolation, to drive our performance and also to preserve capital in the fund. Throughout the economic cycle, it gives the investor full market exposure to the ASX 200. But at periods through the cycle where you have the flexibility to be quite defensive in the 130-30. We have the ability to go 80% long and 20% cash, thus protecting the portfolio. We also have the ability to go 150 long and 50 short, where the shorts will act as protection to the portfolio as well. We use short selling for 2 reasons: to profit from companies that we perceive have earnings risks, and thus we short those companies and anticipate an earnings warning coming through in the next 12 months. But we also short sell companies to manage the risk of the whole portfolio and also the market risk if the market does slide by 5 to 10%. When you're looking at a 130-30 fund, effectively you're 100% long, 130 long and 30 short. The key risk to that type of strategy is the 30, is the short. Because in a long strategy, if you get a long wrong, it becomes smaller in your portfolio as the market goes down. In a 130-30 strategy, if you get a short wrong, it becomes a bigger proportion of your portfolio. Thus, you need another layer of risk management to ensure that you protect the shorts. A good example of this is that sometimes there's a smarter way than just short selling stock. We'll look at the derivative market and buy a put. Thus, we know what a total cost and obligation will be. This fund suits an investor who wants full equity exposure in the Aussie equity market. It suits an investor that wants good, solid, strong outperformance, but low risk and low volatility. The investment horizon is over 5 to 7 years, so we are looking for a long-term investor that likes good outperformance and low risk.